The market closed out last week sitting right at a breaking point, and if we break, things certainly become more dangerous out there. Throw into the mix that we've got CPI, PPI, retail sales, and even unemployment claims, all as fundamental catalysts, and it should be a pretty wild week. So let's build out a game plan that's based on logic to determine whether or not the odds have actually increased for a break here, or if we should expect the daily high or low to hold. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we're certainly looking at a solid red-bodied bar with just a little bit of a lower wick on the bottom, implying some buy-side pressure here. However, the sellers did do a great job of closing weak in the lower third of the overall range, so from a structural perspective, sellers do have the upper hand. If we think about location on the bar-to-bar count, we do have ourselves a lower high as well as a higher low, giving us a very classic inside bar, which as we know is very neutral. We'll learn something when and if we can breach the inside bar high or the inside bar low for some range expansion. But if we add in a little bit more context in terms of location, remember that this was the original weekly range that we've been trying to resolve. Ideally, the weekly high or low wanted to form above. It did not. We went into that range, and you can see on the upper wick of the candle from 3 weeks ago, that's this one right here, we actually rejected this area of prior resistance. It no longer acted as support here. It was acting as resistance once again. So the threat on the weekly time frame chart, just to set the stage, right, was that a head and shoulders was brewing. And as we breached the top of that 2 weeks ago, now it certainly starts to look more so like a break, retest. Can we hold it for a higher low and continue the weekly uptrend in the upward direction to produce the equal high closer to 460? And once again, where's the lower wick of last week's bar forming? It's right on the retest of that level. So when I say breaking point in the intro, it's because if we can hold on to this, it would seem to me that the weekly trend is remaining ideal in the upward direction, and we can once again search for the equal high somewhere up here. If we fail that, we jeopardize coming into the equal lows over here, which as we know is the last higher low on the weekly time frame chart. And then this certainly cements itself as a weekly lower high, right? That's the threat, and that's why things become much more dangerous if we cannot hold on to this breaking point. And if we break underneath, you would have to concede that if this is going to be a lower high double top, breaking the neckline here and bringing in some sort of lower low would change the weekly trend, which would not be ideal. Because remember, as of right now, the weekly trend is up. There's no changing that. We've got lows, higher lows, higher lows, higher lows. We've been tracking this for quite a while. We pulled back from a higher high, found a higher low at what was once soft lows. Daily downtrend confirms this as firm lows now. We're looking for the equal high. So once again, the threat is that if we cannot hold this, the equal low here threatens a weekly trend change, and that would be the first time in a very long time that we've had a weekly downtrend. It's also worth acknowledging that if we just look at the trend in isolation of this box, we're in the midpoint of that range. And as we classically say around the channel, you don't really have an edge in the midpoint of a range. You have an edge at the edges for a breakout or mean reversion, and the same is true but opposite at the bottom, mean reversion or some sort of breakdown. So for that reason, we're very cautious navigating around this breaking point for our market. As we know, it's that legendary 445 level. The other thing to contrast this to, of course, is this segment right here, where the trend is clearly up and there's clearly momentum in the upward direction. That's coming to an end. Things are slowing down here. We have to stay nimble and at least be open to the idea that the weekly trend can change if that breaking point does not hold. Let's see what else we can learn about this. If we throw on the anchored VWAPs, what can we see from that perspective? We are above the entire cluster of anchored VWAPs, and once again, that lower wick of last week's bar tries to respect the AI Mania breakout anchored VWAP. So for me, that's a bullish data point here. As long as we're above that, as long as we're above the breaking point, that again, it's definitely more bullish than bearish. We could take a look at the high volume nodes. What is this showing us? If we take a closer look over here, we'll zoom way in on this. This is the high volume node, and boom, as we know, no surprises here. It is the same exact level. It's that 445. Now we have the opportunity for a break, retest, and hold now as an area of support from what was once acting as resistance from 3 weeks ago in the upper wick. Just as a reminder as well, we'll come in with the Fibonacci's from the all-time high to the October low, from the bottom here to the top, and from the AI Mania low to the top, and once again 61.8, 38.2, and 61.8, all confluence of support roughly around 430. I know that the weekly higher lows are here at 432, but the general idea on the weekly time frame chart is that this is starting to feel much more so like balance. It is not bearish though until we can break down underneath this level. Again, let's not split hairs. 430, if we're underneath that, we will change our tone, but if we're above, it's balance until proven otherwise. Ideally, we stay above that breaking point and continue to look for weekly higher lows to come up and test the weekly equal high for trend continuation. That would be the ideal situation if you are a bull. Let's take a look at the daily time frame chart. Let's first evaluate the expected move. If you're not familiar with this study, check out the video tutorial in the top right hand corner. If we're contained by the upper bound, the number is 451.81, and that of course would be a very nuanced lower high. That is a bearish indication. If we're contained by the lower bound, the number is 439.27, and technically speaking, that would be a higher low. That is a bullish indication. So overall, expected move does strike me as neutral for that exact reason. If we think about daily trend is also becoming more neutral without the ideal hold of this key level at 445, right? We know that in the past, this was a high, and this was our first daily lower high after flipping into an hourly uptrend. Ever since we broke the neckline of that double bottom and produced a higher high, we've been pulling back from the higher high, which would imply that the market can certainly afford a higher low pullback. And the ideal location for the buyers to step up would have been at the neckline of the pattern, also the origin of the breakdown, prior support. We've talked about this level, week in and week out. 445 was that number. And it's worth conceding that, yes, the buyers did start to step up there in the lower wick of Wednesday's session on the exhaustion gap from Thursday's session, but we are not really seeing the ideal response that we wanted from the buyers here. I mean, we've rejected the 50 SMA on Friday's session on the back test from the bottom up now. And just like we talked about on Wednesday, put yourself in the shoes of a seller, right? You really don't want to see the close in the midpoint of that range. You wanted to see a weaker close. On Friday, put yourself in the shoes of a buyer, right? If you're a buyer here, you want to see the close at or above the 50 SMA. You do not want to see a retracement back down towards the lows of day. I would certainly concede that although we did close above the 445, it's certainly not a bullish looking daily candlestick, right? The inverted hammer would suggest that sellers stepped up in that upper wick. So not really feeling great about the daily time frame chart as much so as we were on the Wednesday session after that lower wick was produced. So buyers are trying here. It's just not the ideal response that we were ultimately looking for. As a general reminder, because I'm sure someone is going to bring it up, if this is going to turn into a daily head and shoulders, that's fine, but please do be patient for the neckline breakdown, which as of right now would be somewhere roughly around 436 if you are using a trend line. If you want horizontal levels, I would just wait patiently for the weekly lower low to be brought in underneath 432 that we were just talking about on the higher time frame. Let's take a look at the hourly time frame chart to really build out our game plan here. And again, you can clearly see the daily trend reversal with the hourly higher low. There's your neckline, there's the big time higher high, right? But in the short term, the hourly has gone high, lower high. This is your lower high. We've produced lows, lower lows, maybe even lower lows here. So we're in a very short-term hourly downtrend. If this is going to reverse, if the daily higher low is going to be defended, you ultimately need to take out the last lower high, which is here at 446.85. That will be a key level. It's also the daily 50 SMA. That'll be a key level as we move forward into the early stages of this upcoming week. From a pattern perspective, right, you'll also notice that, remember on Wednesday's update, we talked about how there was thin structure over here. The buyers kind of failed at the highs of Friday's session, taking out this congestion here. In theory, we had thin structure to retrace. Why were the buyers unable to really step up there and really rotate up towards the gap? It just simply didn't happen. So seeing some failed evidence from the buyers that, maybe this isn't not going to hold as ideally as the higher low on the daily chart that we wanted. Now, it's not completely off the table because once again, let me not, forget to remind you, we did technically close over 445. You can clearly see on the exhaustion gap down that sellers were not really willing to commit down here underneath 445. So it's still on the table. It's just not nearly as bullish as it was on the first test. If we think about structure here, what would structure suggest? Well, there's a couple of things that could happen. If this is going to be a double bottom, again, you've just got to take out that neckline at 446.85. The gap overhead would become the target, and then you would look for a more severe reaction here at 450. Overhead supply, is it going to reject price? It's certainly a possibility. So that's your double bottom. You could also make the argument that this is sort of a really ugly and sloppy inverted head and shoulders. The point point still stands, though, that you have a low, a lower low, a higher low. The neckline is still the exact same level. It's Friday's high of day, basically at 446.85. If we can take it out, we'll look for that upside rotation, and that would be bullish. So how does that stay on the table as a valid setup? We're neutral to semi-bullish if we're above 445, but underneath 446.85. In this area right here, neutral to bullish, looking for that as an outcome when and if we take out 446.85. If we slip underneath 445, I would be neutral to bearish in here, just noting that we're not yet producing a lower low, but if we do break down underneath 443.25, that ushers in basically the failure of the daily higher low, and we would look for the Monday low of 2 weeks ago at 441.25, then the lower bound of the expected move, and also the breakout from the Friday session of that would now be 3 weeks ago when we first saw that failure from the sellers. So that's the downside and the upside here. Once again, based on what I'm seeing, I would be very open to the idea that maybe this can hang on, but as we'll see in the internals, it's really not bullish out there in the underpinnings of the market. I would not at all be surprised if the market tries to slop around in here, and then as we get CPI, PPI that's coming out on Wednesday, that acts as the catalyst to either gap us up towards the neckline or gap us down underneath 443.25. With all of that said, let's take a brief glance at our anchored view apps intraday, see if we've got any confluence. Yes, we do. More bearish underneath the bottom anchored view app coming from the bottom of the double bottom. If we take out the neckline of the pattern, that is the higher low part of the double bottom, that would be here. And you can see clearly resistance from the breakout of Tuesday of 2 weeks ago. That's going to be at the beginning of the gap. That gap, by the way, is over 448.50, closes to 449.15. And once again, 450 is the stronger retest area. Anything from the Fibonacci perspective, if we come in from here to here, not much to really write home about. Actually, I suppose the 38.2 kind of is right around that neckline area, reinforcing the idea that if we can clear it, that would be more of a bullish indication. How about from high to low this time around? If this is going to be the end of the downdraft, let's come from here down to the low, and lo and behold, actually, you do have your 38.2. So if this is going to act as bear flag consolidation for a breakdown, you cannot really afford to break out over that neckline. So it just reinforces the idea of that 446.85 level. Friday's high of day will be paramount if this market's going to move in the upward direction. If we're underneath it, it's really much more so neutral to slightly more bearish consolidation. Let's take a look at some more supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, you can see that the sellers dominated at the exchange level. Now, no individual day breached and closed underneath negative 300 million from a volume flows perspective. However, net flows on the week were negative 510 million. Our substantial read is net positive or negative 500 million. And on a shortened holiday week with only 4 days of trade, that does strike me as substantial outflows. The other thing to point out is that clearly on Friday's attempt to recover up and over Thursday's highs, there's really no strong buy-side reaction. We're basically at parity at the zero line all day on Friday. So no substantial reaction from the buyers trying to defend that daily higher low. Similar comments over here in the advanced decline line, getting very close to trend lower zone on Tuesday, falling off of a cliff on Wednesday when the breakdown happens, of course. And then Thursday, pretty bearish under the zero line. Friday's attempt to get bullish fades back down to the zero line by the time the close comes around. Once again, no evidence here that buyers are really trying to step up and defend the daily higher low. Cumulative ticks tell the same story, bearish, 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 and even bearish into the afternoon of Friday. The one concession here is that we're typically looking at substantial reads being underneath or at basically negative 5,000, positive 5,000. None of the daily reads got there in the past week's worth of trade. It's not the end of the world. Obviously, this still has much more of a bearish tone than bullish tone, but it's just not maybe as bad as it could have been. The other thing to point out before we continue along is that futures will be rolling this week, so watch out for the ES. You want to trade the contract that has the most volume. We're going to go from the U contract to the Z contract, and there's about a 50-point spread right now between the two, so keep your wits about you. We'll update you in the pre-market preps. I'm not going to give you any futures numbers for that reason today. However, internals, they kind of speak for themselves. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Once again, there will be a futures roll, so ignore the actual price data here, but the market structure is important. Notice that on the Friday session, the point of control, it tries to move higher, but it ultimately closes towards the midpoint of Friday's range. Compare that to the Thursday session, where we certainly have value higher, point of control higher, this would be an indication that on the follow-through attempt from Friday, once again, buyers did not really step up there in the manner that we would have liked. Also, we did get a point of control that was underneath that of the Wednesday breakdown in the first place. You'll also notice here on the market profile, we had a string of single prints from the breakdown on the Wednesday session. And lo and behold, on the Friday, we did attempt to move through that thin structure. And you would think, once again, that the buyers should have an easier time getting through that thin volume back up here to close that gap, as opposed to a more difficult time. And there was clearly a rejection there at the high of day on Friday, speaking to the lack, again, of strong buy-side pressure. The other thing to point out, of course, is that we have extremely poor lows on Friday as well as the Thursday session. Wouldn't that be something if coming down to repair those poor lows actually ushered in the further downside break of that key weekly level? Something to be thinking about. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the XLU utility sector, lightweight D for defensive sector, actually led the pack up 0.93%. And at the bottom of the barrel, it's the XLI for industrials, down 2.74%. Industrials do feel more risk on, but they are a lighter weight risk on sector. The heaviest weight risk on sector is the XLK tech sector, of course. That was down 1.69% with Apple's big debacle in the downward direction. But aside from that, the XLY, consumer discretionary XLC communication sectors, they really weren't all that bad, down 0.37% and 0.1% respectively. I would be much more concerned if the structural charts looked different, but as we'll see right now, it's really not all that bad from a trend perspective. They're neutralizing at best. They're certainly not bearish in the heavier weight risk on sectors. Let's take a look at the XLU, right? So overall, is this a downtrend? The answer is absolutely. Is this a counter trend move in the context of a downtrend? The answer is once again absolutely. Is it possible that utilities could set a lower high somewhere on the back test of roughly 63.75? I think the answer is absolutely. So from a leadership perspective, I'm not concerned about utilities making an uptick here until it actually takes out and produces a higher low above 63.75. That would technically be the number that you want to watch out for. Certainly bullish into the end of this week. I mean, undoubtedly, a couple days of momentum in the upward direction being kicked off from a gap up. That's noteworthy. However, we're just not above key structure yet where we would say, okay, this is more of a threat to our market posture. Certainly the possibility of a lower high still over here. Next up, XLE for the energy sector. As we know, this is sort of the issue with inflation right now. And you'll notice that we continue in the upward direction outside of building block. Potentially, let's just call that number 2. This is number 1. Building out building block number 3 just means staying in between 93.15 and above 90 with the inverted hammer from the Friday session. Wouldn't be unreasonable with, this is a pretty decent move in the upward direction, right? Digesting that a little bit of consolidation, a pullback here certainly would seem healthy for energy. And once again, that speaks to inflation maybe, but it's not really the end of the world from a sector posture perspective. Next up, industrials. What's going on over here? Took a little bit of a beating, right? Moving for a 100% retracement back down to the equal low. Just a reminder, you don't want to be short on the equal low 100% retracement. You want to wait for a lower high, then reattempt in short proximity of time. There's some thin structure to retrace over here. Underneath 105.35, 103 becomes the target. That would be bearish drag for the broad market. Notice that we do have a daily or even weekly lower high in place here. Not looking great over in industrials. XLB for materials, really lightweight sector, trying to do something similar with a close to 100% retracement. As long as we're underneath 82, it strikes me as bearish drag for the market. If we can get a higher low back above, maybe it becomes constructive with the attempt at a weekly higher low, but being such a lightweight sector wouldn't be my main focus. XLK would be a main focus though, and what you can see is that we've basically retraced back up, to the origin of the breakdown. So yes, there's the opportunity for a weekly lower high. However, the move from here all the way up to here with a higher low along the way, attempting to find a higher low here over 170.25, it's very difficult to say that the XLK is in extremely rough shape. If anything on the weekly time frame, this is starting to become a range, not a glaring and raging downtrend. If I just zoom this out, right, this is certainly a strong uptrend. It would be very difficult to classify this as a very strong downtrend. Could it be the beginnings? Maybe, but we don't really have a sweeping downtrend out there in tech. There was definitely a hiccup in here, don't get me wrong, especially with the NVIDIA move to the downside. Apple gap down, of course, is a little bit of a threat. However, structurally speaking, is it not possible that the daily time frame chart could find a higher low over 170.25 after taking this out? You get your higher high, looking for a higher low, right? Pulling back from a higher high. To me, it's a very reasonable outcome. So I wouldn't be bearish on the broad market unless the XLK can really slip down underneath 170.25. If it's in here, it's really more neutral than anything else. To be a bullish factor, I would want higher lows up and over 175.70. Let's take a look at the XLV healthcare sector. D for defensive, but also the second heaviest weighted sector by market cap. It's playing nicely. It's not outperforming. Obviously, it's broken down into the end of last week and two back-to-back inverted hammers rejecting the backtest of that level. It does strike me as more bearish than bullish, but once again, from a posture perspective, not seeing this lead, okay, not the end of the world, right? Really not the end of the world here. Next up, XLF. Pretty pleased with this one as well. We know that this held for a weekly higher low, attempting to build out daily higher low from here to here. And of course, what we're looking for is a breach of 34.75 to become much more constructive in the upward direction. If that can take place, that would certainly be a help for the bull case of the broad market. If we start to break down and come towards the equal low, yes, we would have a lower high on the weekly, and this would become a big threat. Taking out 33.65, no good for the XLF and for the broad market as a whole, really. A couple of back-to-back hammers, inverted hammers, pretty indecisive around the 34.20. I would wait for this 3-day balance to resolve to get an indication for what financials want to do earlier on in the week. Next up, real estate, really lightweight sector, sideways in this overall range. We'll let it be. XLP for consumer staples. What's going on over here? D for defensive classically. Very similar story to what's going on with the XLU. Big move lower, right? Bear flag building out. As long as it's underneath 72, not a threat for leadership. Downward pressure is still downward pressure, but if we can get the pickup from the XLK, which is much more so, like, here's a quick compare and contrast, right? Does this look anything like the longer time frame XLK chart? XLK is clearly outperforming, and it has much better bullish structure underneath it than something like the XLP. So I'm not really seeing the reasoning for a risk-off rotation, given that the XLK is located where it's at, up towards the top of the preceding uptrend, right? This, it really just strikes me as, okay, maybe if there's a counter trend move, it speaks to a pullback or consolidation in the S&P, but there's no full-blown flight to safety that I can see from a posture perspective here, or even just the structural charts that we're ripping through. Again, here's just another glaring example. XLY, uptrend, downtrend, or sideways. I mean, clearly uptrend. Maybe building out a weekly sideways trend up here, but in the context of digesting this overall up move, right? Let's take a look at what happened in the last week's worth of trade, respecting the neckline of this as a double bottom. The buyers did step up kind of where we wanted them to. And once again, this is kind of what ideally we would have gotten out of the S&P. It just didn't happen that way. So if this is going to help the S&P continue to hold the double bottom neckline, right? You ideally want the XLY up and over with a higher low, 170.25. Neutralizing in here is exactly that, neutral. If we slip underneath 166.50, I would concede the bearish point and say, yes, that is obviously drag for your S&P as a whole. XLC Communications, once again, these charts, this is why we check in on them week in and week out, even if there's no big update to bring. It's when the market starts to shift around like this, maintaining resolve in what's already happened, right? And seeing that very obvious compare and contrast, risk on versus risk off sectors. So what do we see up here? If this is a weekly range that's building out, we're in the midpoint, once again, not much of an edge. I would say that the bulls keep things in control up and over the neckline and the breakdown point from the NVIDIA earnings move, as long as we're over 66.75. Pretty bullish for the broad market. Ideally, we continue to further the bull case for the S&P if we get a higher low over 68.10. If we slip underneath, that's where we start to say, okay, maybe we're in jeopardy for a bit of a move lower over in the S&P. But overall, I think that the sectors sort of neutralize some of the analysis a little bit and say, okay, you know, it doesn't look great over in the S&P, but maybe we should be more neutral than bearish even on just a big breakdown on a flush to the weekly equal lows. Even the ratio grid ties into that narrative quite well. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Is it not logical that this is a new budding uptrend in the XLK ratio? Is it possible for a higher low here? The answer to me is yes, over a now flattened out 50 SMA. XLVD for defensive underneath a 50 SMA. XLF needs some work, right? This is certainly more neutral. Same thing over here with the XLY. It's trying, it's definitely trying, but it needs a lot more work to be more so a risk on indication, right? XLC, same thing, sideways in this range. So the risk on revival is really hinging on improvements in the XLY and a breakout here in the XLC. And in terms of risk off, I think this aligns with what we were just talking about structurally in the sectors. Notice that the XLP has an opportunity for a big time lower high here. It's in a pre-existing downtrend. Same thing with the XLU relative to the S&P. There's an opportunity here for a lower high. It's in a pre-existing downtrend. So I'm not seeing a full-blown risk-off style rotation. We know that energy is the thorn in the side from an inflation perspective, but the risk-on revival lives on as long as this can hold a higher low at or around the 50 SMA, and ideally, we see the XLY show improve. Let's take a look at some specialized ratios like the XLK versus the XLU over here. Again, broke to a new higher high, Pulling back, is it logical that we could find a higher low up and over an upward sloping 50 SMA? Absolutely yes. And once again, that would speak to risk on posture for our market. We would be concerned if that deteriorates, right? The XLY versus the XLP, so discretionary versus staples, you can see produce the equal high and just sideways into the close of the week. Really nothing in terms of major pullback. And once again, we can afford a higher low pullback now that we at least have the equal high. Staying above the midpoint of that range, which would be right around in here, would be constructive for the risk on posture. The dollar, as we can see, broke to a new higher high and consolidated into the end of this week, making total sense that the market pulled back and really struggled to move in the upward direction, or just that stronger buyers weren't really showing up. If this does decide to pull back, that could coincide with a stronger move higher out of equities, but we know that we can still catch ourselves for a higher low in the dollar, maintain this uptrend here, and ultimately target the top of the range after experiencing a look below and fail here. The target always becomes the top. That would be 105.65 in the dollar for something that would do this, and thus, once again, after maybe some sort of rally, we have to question how sustainable that ultimately is if the dollar continues to move higher off of a higher low. So that's the main dynamic to continue to watch, but after breaking to a higher high, it would seem logical that the dollar could consolidate some of those gains by pulling back. If it does break out, obviously we know that the classic relationship is bearish for equities down below. What does the gold contract have to say about this? If we take a look at the most recent move, it's back down underneath the 1950 in here, and we are rejecting it in the two upper wicks from Thursday and Friday, confirming the bullish consolidation we saw over in the dollar. So if this breaks down, expect a higher dollar, expect lower out of equities over here. If this can recapture, which again does not look likely given the back-to-back inverted hammer rejections, maybe it's a slight bullish force for the broad market, but as of right now, not looking so hot. Let's take a look at the TNX, because all of this really hinges upon the expectations for rates. From a technical perspective, again, this is very much so an uptrend. We just held for a brand new higher low after pulling back from a higher high. We consolidated all week up here. I would be very, very mindful, even watchful of what takes place out of the TNX, specifically around CPI as well as PPI. Do we break to a new higher high? The market probably does not like that one bit. And I would imagine lower here in equities if we find ourselves above 43.33 in the TNX. What does the inverted ZT have to say about this from a Fed tracker tool perspective, confirming or denying? And it's still hanging out in the sideways area, which we know represents a pause from the Fed. If we take out the top, it's a hike. If we take out the bottom and produce a new lower low, it is a cut. Let's look at the tracker tool now. No big updates on the tracker tool, still experiencing the prolonged pause, as we can see at 525 to 550. And if we take a look at the calendar for the coming week's worth of trade, obviously the CPI print is the big deal. Core month over month expected to come in line with a 0.2. That's typically okay for core. But notice over here, the month over month non-core 0.6. Oof, that is going to be a tough look. Also, the year over year expected to come in at 3.6 from a prior at 3.2. If these inflation reads come in hotter than the expectations, I would expect that the Fed's hand is forced and we do see another rate hike in that November timeframe, which is currently what the tracker tool is pricing in for the higher probability, right? 43.6 versus 42 in the December timeframe. And as we know, if we go back to the calendar, we did get services PMIs on Wednesday of last week. And recall, we talked about this in the midweek update. They came in not only above 50, but well above the forecast, which is expansionary. So services inflation remains kind of untamed. We know that the energy crisis in CL is blasting off literally like a rocket ship. And if we go over here, right, we haven't talked about this in quite some time. However, financial conditions continue to ease, which is kind of the opposite of what the Fed basically wants to happen here. So I wouldn't be surprised at all if the CPI inflation print comes in hotter than the expectations. And you better believe, like, here's just the caveat, right? We never try to predict this. Obviously, the information in hand would suggest that it could come in hot, but you better believe if these numbers come in at or below I wouldn't say at, but if they come in below expectations, market's going to rally. I just don't see a situation where the market would not rally if we have all these bearish expectations of higher inflation and the numbers, kudos to the chefs out back, we'll clap it up for them. But if they come in underneath expectations, I can't see a world in which the market would not rally on that information. How about the market's appetite for risk? TLT ratioed to our S&P, still underneath that resistance trendline. However, it is worth pointing out that the slope of the decline is certainly flattening out a little bit. We are mellowing out, which might speak to a subtle change in tone, but we have certainly not broken the trendline. So not currently seeing a flight to safety. It's something that we'll continue to monitor. I think that the bigger indication is really what's going on with bonds in relationship to one another. Notice that we did not take out and produce higher highs. So not bearish from that perspective, But again, what do we want to see if we're bullish? We need the lower lows. We need a lower low underneath here. We need a lower low underneath here and underneath over here. And we certainly do not have that as of right now. If anything, they look to be threatening a higher high, which would be a bearish and sort of quote flight to safety style trade. They just haven't broken to the higher high yet. So we'll update you on Wednesday, of course, if that does happen. However, they're not helpful for the bull case right now down below in equities. Let's take a look at the, a couple of clicks there, credit spreads. And these are actually moving in the right direction, right? You can see that we did produce the lower high. We did produce the lower high. Now, once again, you just want continuation of that downtrend with a lower low. But so far, so good over here in credit spreads, and HYG in isolation actually rebounded quite substantially off of this low, right? You can see the equal low and a big move in the upward direction. Obviously, the threat is that if this produces a big time lower high and finds itself back down here at the equal low, you better believe it would start to imply that equities could break down through the trend line, no longer hold that key level that we've been discussing on the SPY daily, which as we know is just roughly 445. If the HYG finds itself underneath 74.25, again, probably looking for a breakdown in equities. Let's take a look at Bitcoin just to see what's going on with the digital gold, and it's an absolute just snooze fest over here. Nothing going on, so let's move along. Market breadth, new highs versus lows was above the zero line, and now we're right back down to underneath the zero line. We did not make a lower low, and sometimes in the early stages of a trend recovery, we can see some reads close to zero, but we really do not want to stay negative here. And if we do see a lower low, I would sort of look out below in equities. That would be underneath negative 73 on new highs versus new lows. Let's take a look at the SPX A200R. Stocks trading above the 200 SMA in the S&P, and once again, no hold here, no dice at the 50% move, so breadth is deteriorating sort of underneath a pretty big milestone, which is no good. Again, breadth not really great, and you can see the same thing here in SPX A50R, 50 SMA, of course, producing a lower high underneath the 50% mark in that sort of reading. We did not produce a lower low though, so open to the idea that maybe if this flattens out, the market sort of consolidates, but it's still really not a helpful look for the overall broad market. Let's take a look at the RSP, because this is also somewhat alarming. Notice that we are underneath the neckline a bit more firmly. Now they're back-to-back, indecisive dojis, hammer-esque style bars, but there was no hold of 148, especially after the hammer that was produced on the Wednesday session. So not a warm and fuzzy feeling here. Strong odds after a breach of this level that a lower high could be produced even on a rally underneath 150, which would keep us bearish down below in equities. And here is the Dow Jones. What's going on with Dow Jones Transports? You can clearly see breaching to a new lower low. I know for a while we were like, okay, everything's fine and dandy. This is why we look at it day in and day out, because when there is a divergence, it will become so obvious it jumps off the page to you. So we have a higher low in industrials and a big lower low over in transports. This would stack up as a bearish data point. VIX volatility looking quite comfortable underneath the 15 handle here, rejecting that on the Thursday exhaustion gap down and even in the upper wick of Friday's session over there. And this would actually speak to bullish odds of trying to hold on to this as a higher low as long as we're underneath the 15 handle in volatility. And just remember, this is one data point. You could easily back this up and say, okay, but market breadth is bad, so those kind of neutralize out, right? In terms of VVIX, what's going on with volatility of volatility, sort of towards the midpoint of this as an overall range. And just as a reminder, that's actually more healthy than being slammed towards the lows at 75, which open us up to the complacency effect. We're certainly nowhere near the 103 inflection point in the upward direction. What about VIX futures? Taking a look at volatility futures here, rolling over to a deeper contango into the end of the week. Same thing in the 9 versus 30 day, and the 1-day VIX even building out a lower set of lows over here. So volatility seems kind of okay as of right now, but once again, balance that out with the bad breath, for example, with the opportunity for a breakdown underneath that SPY level. So again, one data point here. I think with this mixed bag, the biggest threat is if the weekly trend starts to shift in the downward direction. As of right now on the daily, a little bit more neutral feeling than anything else, once again, with all of these mixed data points. QQQ weekly time frame chart. What do we see here from a candle structure and location perspective? Very similar to our S&P, however, maybe a little bit more of an upper wick. I should have maybe done something like that, a bit more appropriate. However, same concept where the sellers do a great job of closing in the lower third of the overall range, maybe a little bit of buy side pressure in here, but not enough to really change the weekly structural perspective. So sellers, they get a check mark in terms of location, same concept, lower high, as well as a more substantial, I would say, higher low, neutral, inside bar if we take out out the inside bar high, we look for something. If we take out the inside bar low, we also will look for something. If we extrapolate out a little bit more in terms of location, just pointing out that the lower wick once again is respecting the prior resistance and prior resistance from over here, trying to be constructive for a weekly set of higher lows to be found. And once again, lows, higher lows, higher lows, higher lows have been cemented with this as a daily downtrend. Most constructive would be staying above the breaking point in here, which is roughly 372. We know that area quite well from the neckline of the daily double bottom. Same comments about the potential for a weekly lower high, only if we can take out these lows right around, let's call it like 357. We'll see that on the daily chart in just a moment as well. In terms of our anchored view apps, we can take a look on the weekly here. We are above the AI Mania anchored view app, which comes from back down over here, above the entirety of the anchored view app cluster. If we scrunch this out, we can take a look at our Fibonacci's. We're well above. This is more so in alignment. We're looking for 350 with the big confluence level here on the QQQ weekly, right? If we do something like this, there's your big alignment, 61.8, 38.2, 61.8, 350 is the number on the weekly time frame. I would still be much more focused on the actual candle structure. If we take out this area, which is north of 350, closer to like 357 as we were just talking about, that would be taking out the neckline of your lower high double top and ushering in some sort of lower low. Let's take a look at the volume profile, anything from that perspective, and it's the same old song and dance. I mean, there is your high volume node. It's a break. It's a retest above that, trying to act as support now. If we can hold it, it's looking okay. It is looking okay if we can hold on to that QQQ 372 area. Let's go ahead and do it this way today. We'll go on over to this and we'll flip over to the QQQ daily time frame chart. What do we see over here? Once again, how does Friday react? Probably not ideal if you're trying to be a long looking for the defense of that neckline. Once again, that level is 372, but we did technically close above. We also closed above our 50 SMA, unlike the rejection over in the SPY. So not ideal, but certainly not the end of the world yet. In terms of trend, right, we are pulling back from the higher high, same concept there, certainly acting as a higher low. Ideally, we get some sort of consolidation in here, and then a higher low back within 375.75 for this overhead supply to rotate towards the top at 380, even as an overhead target. Your lows that we were just talking about on the weekly time frame chart, once again, boom, 355. If I hover the cursor, you can see, there we are, what did I say, 55, 57, 357 is your weekly level for the QQQ. If this is going to turn into not a head and shoulders, but if you've been in the chats in the morning, you know what pattern it is. We're going to brand this as a trade brigade pattern. That is the Man Ray pattern, and I'll put an image up on the screen right now so you can catch the reference. So only a Man Ray pattern if we take out and produce a lower low. And once again, that's more relevant on the weekly time frame chart. Here's the hourly chart. What else can we learn about the hourly structure? Similar comments to the S&P with lows, higher lows, looking for the higher low. Again, that's your daily structure, right? The hourly structure is highs, lower highs. This is your lower high. We've got low, lower, low, lower, low. So we need to take out 374.50 as a potential neckline of this as a micro, and nuanced double bottom in here. Then we'll look for the recapture and higher low. This one's going to be tricky because even when you take out the neckline of that pattern, you're running into overhead supply retests at 375.75. So the long's actually probably going to be easier in the S&P if the markets break to the upside, and the shorts will be easier in the QQQ. What's the reasoning behind that? Well, if you look left, taking out this 372 with a lower high underneath, you've still got more thin structure to retrace from this big mania breakout on the Tuesday of now 3 weeks ago. So those are your ups from downs. We can throw on the intraday anchored view apps to see if we can learn anything more about Confluence. Pretty much in alignment with what we just talked about. Lower highs underneath 372. Start trading for downside outcomes. Thin structure retrace is 367. Consolidation in here is sort of neutral, maybe a little bit more bullish, but even still, you've got to clear this overhead level. And once again, there's your anchored view app Confluence with 374.50 as your potential break level. I would like to see something like that if we are looking for longs. And again, the SPY seems to be right now the easier long. This would seem to be the easier short with thinner structure to retrace to the downside. Let's take a look at the market internals for the NASDAQ side of things. And, it's the same thing. Cumulatively on the week, we are at negative 531 million. Classically, we're looking for 600 million. But remember, with a shortened holiday week, the S&P technically got over the hump of 500, but this was just shy by about 70 million. But nonetheless, the bears do have the upper hand here with bears bearish reads here, and here. Friday, not really a strong attempt. Same thing, right? Over here in the advanced decline line, bearish, and under the zero line on Friday, all cumulative builds are bearish as well. Nothing really new to report in that department. Here are the market profiles for the NQ side of things. Again, keep in mind the contract roll. We have a very poor high and a very poor low. I would look for something to happen, a break basically, as we test and potentially get into the Friday high of day, or test and get into the Friday low of day. Looking for a break on either side, but we still have another poor low on the Thursday session, right? You can see the A and B back-to-back TPOs. So just like the S&P poor structure underneath, we did not attempt to get into the thin structure overhead over on the NASDAQ side of things. So once again, this does not strike me as being as much of a failure from the buyers. So, you got to balance the structure overhead in the S&P and the ease of upward activity versus the lack of failure over here in the QQQ. It would also just beg the question, why were the buyers unable to get there in the first place, right? So maybe it's weaker from that perspective. So sort of trying to balance that out and think about who is going to get hurt and where. As of right now, I think just going back on over to the platform and rounding things out, the game plan is very straightforward. In here, kind of neutral, looking for scalps, staying nimble in that area, a little bit more bullish on a higher low over 375.75 and weaker on a lower high, looking for shorts under 372. All right, the Russell weekly time frame chart. This is where we've got to have a little bit of a discussion. I'm not thrilled at all with what's going on over in the small caps now that we've started to reject and we find ourselves back down at the equal lows from over here. Remember that as we were gunning towards the top of the overall range, the structure underneath us was fairly healthy. We had a big set of consolidation, building block in the upward direction, strong opportunity for some sort of higher low to be produced and attempting to break out of this weekly or even monthly balance at this point in time. Now that the nail in the coffin has been set, and that's on the failure of the green bar, which attempted to recapture after a hold of the 50 SMA, with that failure, so basically last week's worth of trade, the red bar that undoes all of the constructive work from the green bar, not only is there a ton of volatility out there in the small caps in terms of lack of consistency and trend, but it certainly sets up a small cap, aka IWM, head and shoulders, and taking out this neckline to send us back down towards the bottom of the range is not constructive by any stretch of the imagination. From a risk on and risk off perspective, you have to imagine that small caps offer an opportunity for growth. So if investors are optimistic about the future, they're likely going to get involved in some sort of small cap investment. And the fact that this has not broken out over its weekly range, and now we've ultimately undone and produced a lower high here, it leaves me with more questions than answers on the bull side of the market. We're just back in the midpoint of this range. It's kind of do or die here. So not only is it like a breaking point in the S&P, but it's a small cap breaking point as well at the weekly 50 SMA and these equal lows, threatening the head and shoulders breakdown. It's just really not what you want to see for broad market participation in the upward direction. Ideally, Russell would have been doing something like this by now, and we're far from that at this point in time. Let's go ahead and just throw on some quick studies here. Obviously, the candle structure and location is bearish from what we just talked about as a minor discussion. We're in the midpoint. We're tangled up in the anchored view app band. That's really not bullish. Again, ideally, as we were building these blocks in the upward direction, there was a strong opportunity, or attempt at least, to hold that as a higher low, just no dice. And now, obviously, this is acting as a lower high, which is really not what we want to see from the small caps. We can throw on the volume profile because I guess if there's any saving grace, it's just that there's massive volume support down here at like roughly 175. It begs the question, right? When we get to it, we better see a strong bounce off of it, because if we don't, if we break down from this in the small caps as a weekly, monthly bear flag, whatever you want to classify it as, think about all of the people who have positions held from here. It's going to be a snappy move, I would have to imagine, closer to that point of control at like 157, 156, somewhere in there. And that would be huge bearish drag for the broad market. So I'm not trying to be overly pessimistic and suddenly just like switch up on the IWM and switch up on the broad market, but again, the only saving grace was this green bar potentially holding this as a higher low. Seeing it now act as a lower high, it's just, again, I think our conversation has been straightforward and to the point. It's not what you want to see if you are looking for bullish broad market participation. Let's take a look at the daily time frame chart and see what else we can learn about small caps over here. Again, your head and shoulders is as clear as day. If we're talking about volatility, right, there's a couple of things. This is the level that we need to pay attention to, right? On the first pullback, no hold for support. Ideally, you wanted to see this. Okay, so fine. If it's going to be bearish, find yourself a lower high underneath. Give us the head and shoulders underneath that key level of inflection. We take it out to the upside. Okay, let's flip the script again. On any pullbacks, you want to see that act as support if the market's going to remain constructive. Right through it, right through the lower bound of the expected move. It's been back-to-back weeks of just massive blowouts of the expected move. So volatility in small caps, lack of respect for structure, it's just not really what you want to see to be more comfortable in a broad market position right now. So I know we're spending some time on it, but this conversation, I believe, is pretty pertinent to the next little bit here as the IWM potentially tests. I mean, we're getting pretty darn close, the neckline of that area. Even if you wanted to use a trend line, right, and do something like this, it's potentially right there in the early stages of this week's session at 183. If we breach underneath that, I mean, the next big support, 180, 180.25, and then there's a gap to close from back down here, and that puts us right outside of the weekly expected move once again. So not thrilled with small caps over here. If it is going to be constructive, if the market's going to do something that kind of like comes in, swoops in, and quote unquote saves the day, you got to get a higher low over this level. It's the 186.50, and then from there's going to be a big battle. I would have, well, maybe not because of the blatant disrespect a number of times now at the 188.25, but I would imagine, right, that's logically where we could expect something. And if this is going to be a stronger double bottom, I mean, the neckline speaks for itself. We're not even close. I mean, it's not even a conversation point. I know we're talking about it right now, but for this upcoming week's worth of trade, it's a moot point, right? So really not in love with small caps here, given just, again, look at how we had a somewhat constructive trend with higher low pullbacks, give and take. No respect, straight lower, no respect, straight, it's just 100% retracement, round trip volatility. Consolidation down here is bearish, sets up the flush as long as we're underneath 185. We'll leave it off at that for the IWM sort of analysis. The internals would support this. Again, a bearish week across the board over here in the advanced decline line as well, and in the cumulative builds 4-hour tick. The 1-1, this is the only bullish, and I wouldn't even call it bullish, but neutral above zero cumulative tick into the end of this week. But I think that the price action really overshadows anything that's happening at the exchange level. Oops, we don't want that. We want this. Here is the Russell futures, and you can just see how it's liquidation break, liquidation break, liquidation break. Nobody wants to be involved in small caps, which is ironic because on the way higher, it was the exact opposite, right? If we respectfully wind this back, there it goes, being disrespectful. So I don't even know if it's worth it to look. Here we go. Let's try that one more time, and then we'll move along to the core list, right? It was everybody wants small caps. Everybody wants small caps. Just emotional move in the upward direction. All of that has been unwound. So it's like, all right, what's it going to be? What is it going to be out of small caps? As of right now, based on posture, based on positioning, location-wise on the weekly, not looking so hot, not looking so hot. If you've made it to this point in the video, I appreciate you coming out to the analysis. Let me know what you think about the small caps down below in the comments section. I'd love to have more of a conversation about that. But for now, let's kick things off on Apple. What do we see here? Certainly a nasty inverted hammer. This is a daily time frame chart, by the way, and it's a partial gap fill of the big disastrous gap down from the Thursday session. And if we take out the low of the inverted hammer, of course, the next step would really be looking for a move lower after the failure to close the gap all the way. Obviously, momentum is in the downward direction here. So let's take a look at the hourly time frame chart just to get a little bit more clarity on how this might unfold, right? So if we take this out, there's certainly day trade scalps to be had in the downward direction underneath 177.85. Target the low of the consolidation from Thursday at 176.50. Larger slips underneath that get quite dangerous for about a $2.50 move in the downward direction to the low of Thursday, which is at 174. If the buyers are going to hold on to hope here, you really got to reverse the curse, spend some consolidation over here, and close the gap all the way overhead without getting a severe rejection for, the buyers need to see this basically. They need to see the higher low back over the Friday high of day. If that doesn't happen and you get a stronger rejection, oops, that might look something like this, right? Now it's just a gap fill reversal, plain and simple, and we would look for lower after a big daily lower high has been set. Next up is going to be Netflix. Here's the daily time frame chart. We've been getting a little lost in the hourlies recently. It's worth pointing out the daily structure, right? So here's a balance area on the daily time frame chart. If you've got a longer time horizon, you're waiting patiently for price acceptance in the gap. There's a large gap overhead from the earnings cycle. You don't need to be the first one in the door. For selling, you want to be underneath the bottom of the range, which would be at 436.75. Again, the hourly chart might do a better job of actually illustrating the nuance of those levels, but the daily is always good to remind yourself, how much structure actually does exist overhead. What does this look like? We could certainly see and make the argument that, sure, you've got a head and shoulders, but really on the daily, it's just a sideways balance area, right? So not much conviction in this area, specifically after what happened on Friday with some ups and downs early on in the morning. Patience. Patience is a virtue out of Netflix here, or something I would want to see, honestly, underneath this consolidation low at 431.60. Next up is Tesla. Again, let's go back to that daily time frame chart. I made a promise, right? Did I not make a promise in Wednesday's episode? It's got to be this, and it's got to be this. And thank goodness that's how we're acting, because if we do take a look at the hourly time frame chart, what a fake out on the Friday session. Initial drive higher, but completely collapses underneath the midpoint of that range. That's we'll always be advocates that in the midpoint of a range, you don't really have an aggressive edge. It's an edge up here, and it's an edge down here, and Tesla is a great example of that. Next up is going to be GOOGL. What do we see on GOOGL? This one's looking pretty constructive. If there was ever going to be a long in tech, it's looking like Google, right? You get this big break, higher low above the top of the range. You're defending that here, looking for just follow through in the upward direction. How do we get involved on a smaller time frame chart? We avoided the Man Ray. Once again, here is your Man Ray pattern. Avoided breaking down aggressively back into the daily balance underneath 133.65. We held on beautifully to 135. So two things: either we get inverted head and shoulders, pie in the sky on a retracement that holds once again 135, or straight up continuation over 136.50, trade for the equal high at 137.50. Beyond that, we know we have a gap to close overhead. 139.36 closes at 140.43. Next up is going to be Metaverse. What's going on with Zuckerberg's Fantasyland? Wild, just wild. Those are the only words I really have for it on the Thursday and Friday session. Big fake outs, big whipsaws up and down, obviously news driven. Specifically not a fan after we tried to resolve the neckline of this as a double bottom. Seeing the big rejections there, seeing the big rejections to the downside, this is almost like, you got to be very patient or just in and out very quickly with Meta to avoid some of the whipsaws that we've seen. So what does that leave us with, right? If we get some sort of price acceptance over 303.75, I'd be a little bit more constructive on this double bottom neckline resolving higher. If we get some more price acceptance underneath 294.50, okay, different story. This is sort of rejected. This is a couple of fake breaks, and the sellers are probably going to run away with a lot of overhead supply weighing down on the Meta price action. So overall, this is really unfriendly to traders in the intraday time frame. For swing traders, you could probably be a little bit more patient, looser stops, looser targets up here, but those are the primary levels, 303.75 or under something like 294.50. Next up, we've got NVIDIA daily time frame chart. What do we see here? Certainly a double top rejection. The reason I would say that is because we're already back down at the neckline of that area. So a big breakdown of 454 opens the door to close this gap underneath from the pre-earnings gap up, right? That is fairly concerning over on NVIDIA as a downside trade. Anybody who sort of chased the AI mania back here, they're underwater. They're underwater if we take out, at least in NVIDIA, if we take out 454. Let's take it down to the hourly time frame chart, and we can see that we are getting bearish price acceptance after this breakdown from earlier on the Wednesday session. So I think that, the recipe for success here is waiting for a break, and any lower highs under 454 are tradable in the downward direction. If we're just consolidating, I would not be bullish on NVIDIA just based on location here. It would have to turn into some sort of double bottom with the confirmed higher low. I'm not even certain that I would want the higher low over 464.75. I might want the thin structure retracement up and over 471.25. So playing NVIDIA primarily for downside based on its structure there and overhead supply. What's going on with Microsoft? It's not quite as good as Google, but this is certainly looking stronger than what we have in something like your NVIDIA, for example, or even just the Meta volatility, right? So this is a balance range on the daily. You've got a 4 or 5 day balance, depending on how you want to count it. Up and over 334.50 gets constructive to the next level up here, and then the retest of this as overhead supply at 343.25. That would certainly be within reach in the coming weeks worth of trade if the broad market holds on to the necklines of the double bottom. The bigger slip in Microsoft has to be underneath 326.75. So if we take it down to the hourly, again, this consolidation finally resulted in something to the upside. Getting down in here, you might see people try to defend as we sweep back into this area. The better short would be a lower high underneath 326.75. Last but certainly not least, the mini beast, and a couple of trade ideas for you after this. But Amazon, what do we see over here? 137, got to give it to it. Amazon 137 closed back above into the end of this week. Really not all that bad of a weekly bar, right? The weekly bar would look something like this as a dragonfly doji for some kind of higher low. So got to give credit where credit is due. Not the worst looking chart in the world. It's a little sloppy, but it's honestly not horrific. So as long as we're over 137, looking for higher lows. I mean, it's quite clear, right? That turns into bull flag consolidation. Then a breach of 138.60, 140 becomes a target. Anything above that is back to the equal highs around 143. Once again, if you've made it to this point in the video, I appreciate you coming out to the show. Your support means the world. I truly, truly hope every one of you are learning something in the analysis or taking the ideas and making some serious cash. So with that said, What's going on with these ideas? AFRM, affirm, buy now, pay later, is up first on the chopping block as a daily bull flag, and this can resolve two ways, honestly. With the Friday hammer candle looking for longs over the top of 22.56, basically, to trade into 25 even. The options market here is not fantastic. I would just trade the shares straight up. You know, there's plenty. There's plenty of liquidity in Affirm to take advantage of that. To the downside, if it does break from the flag, you could look for a higher low here. That would be the other look, right? A deeper pullback, a deeper consolidation for something that does that. You have pretty good risk reward here, prior highs from back here, put a stop just underneath, and your risk reward is back up to the top, an equal high at 22.56 in the first place. Looking left, it's worth pointing out, if I just auto zoom this real quick, that the 25 is coming from this in here, and then it's really, really thin above that, right? I'm not making the call at all. No stretch of the imagination are we talking about 40 into the coming weeks worth of trade, but I'm just pointing out, if you can put something on, then hold a piece, even as a very small swing, it's kind of attractive through that thin structure. Obviously, glaring weekly downtrend. You're fighting all of that, but the structure is thin overhead. Something to just point out. Let's take a look at GS for Goldman Sachs. What's going on over here? Looking for a double bottom, honestly, and this is almost like a rinse and repeat, right? This over here led to a pretty strong reversal. Can you get something similar with this over here? There's some work to be done. We're just coming off of the second part of the double bottom. We're not yet close to the neckline, but watching for 330, 350 to trade up towards where this breakdown came from after a couple of equal lows. That would be at 342. So roughly, let's just call it a 10-point move in the upward direction, and Goldman does have some decent options chain availability there. So looking for that in the upward direction. That's Goldman. Not interested, obviously, if we don't make it there in the first place. You know, I wouldn't be longing up to the neckline. I would wait until we get there, and then, you know, something like this is attractive, right? Either the higher low above or the equal high break after a higher low, right? That's kind of how I would play that in the upward direction. If we just noodle around down here and drift lower, it's just off the table. It's off the table. Next up would be MA for MasterCard. And notice also, MasterCard and Goldman, bullish trade ideas, financial stocks, right? That could mean that the XLF moves higher if these patterns ultimately play out, right? Especially MasterCard, noting its weight in the XLF as a sector. Bull flag on the daily here, looking for a move up and over 416.56. I mean, this is getting up there in price. These are the kinds of options that, you know, this was the heyday when Amazon was like 3,000. Looking for something like that over here out of MasterCard. I believe that's going to be a new all-time high. Let me double check for us though, and just make sure I am not misleading anyone. Let's go max available weekly. That is a new all-time high. So blue sky territory is up and over 416.56. Manage risk by, you know, trimming at reasonable positions. If you see something starting to slow down, again, use your discretion and sort of manage and trim up there. However, it's looking good. Even on a weekly chart, 3-bar play, right? Inside hammer in the upper half of the preceding, you know, move higher from in here. Looks pretty good to me. So those are the trade ideas I will be watching. Hopefully you enjoyed today's episode of the Weekly Watch List. If you did, let me know down below in the comments section or by giving the video a simple thumbs up. I hope to see you all on Monday morning, bright and early, 8:15 for our pre-market prep. And with that said, I wish you a green trading week.